For decades, China's economy seemed unstoppable, growing at a staggering 9% annually for nearly 40 years, and lifting 800 million people out of poverty. But what if the economic miracle that transformed a developing nation into the world's second-largest economy is actually built on a house of cards? China is now experiencing something it hasn't faced since the 1960s: persistent deflation, with prices falling for a second consecutive year. Even more alarming is the silent exodus of foreign capital from China's markets, with foreign direct investment dropping 27% in 2024, after an 8% decline in 2023. Let me show you exactly why China's economic model is unraveling, why Xi Jinping's policies are making it worse, and what this means for the global economy as the Chinese dragon's fire begins to fade. China's economic troubles are not the result of temporary setbacks or cyclical downturns. They stem from deep-seated structural flaws in the country's growth model that have been developing for decades. The Chinese government has long relied on a system that prioritizes investment and exports over domestic consumption. Under the Chinese model, the state controls and owns significant resources, limits free market activity, and operates through authoritarian CCP leadership. This approach fueled China's initial economic miracle, but also created its most intractable problem: a severe imbalance between investment and domestic consumption. To understand the scale of this imbalance, consider this. Investment accounts for over 41% of China's GDP, compared to the global average of 24%. Meanwhile, consumption represents just 56% of GDP versus a global average of 76%. For 3 decades, China gradually increased investment from 32% to 46% of GDP, while consumption declined from nearly 67% to just 51%. This investment-led strategy worked brilliantly during China's development phase. Massive investment in infrastructure, manufacturing, and property modernized the country, built world-class cities, and established China as the global manufacturing powerhouse. However, like any strategy pushed to extremes, the returns on investment have diminished dramatically. Today, China's economy faces the consequences of decades of overinvestment. Ghost cities with empty apartment towers, underutilized infrastructure, and industrial overcapacity across numerous sectors. The result is an economy caught in a deflationary spiral where prices continue to fall, further discouraging spending and investment. The most visible manifestation of China's economic troubles is its imploding real estate sector. Property has been the backbone of China's growth model, accounting for approximately 29% of GDP, nearly double the proportion in most developed countries. For ordinary Chinese citizens, real estate represents over 60% of household wealth, compared to just 23% in the United States. The property market became China's de facto savings vehicle, with families pouring their life savings into multiple apartments as investments. This created a self-reinforcing cycle. As property prices rose, more investment flowed in, pushing prices even higher. Local governments, which derive 30 to 40% of their revenue from land sales, eagerly supported this trend by releasing more land for development. The result was a massive building boom that produced far more housing than the country needed. China has built enough vacant homes to house up to 3 billion people, more than twice its actual population. There are approximately 7.2 million unsold homes, not counting sold but uncompleted properties, or homes purchased as investments but intentionally left vacant. In 2020, recognizing the dangers of this bubble, Xi Jinping's government implemented the 3 red lines policy to limit borrowing by property developers. This well-intentioned measure to reduce financial risk had devastating consequences, as it cut off the oxygen supply to over-leveraged developers. Evergrande, one of China's largest property developers with over 1,300 projects across the country, defaulted on its debt in 2021, followed by dozens of other major developers like Country Garden. The contagion quickly spread throughout the sector, causing housing prices to fall for 20 consecutive months. A catastrophic development in an economy where most household wealth is tied to property values. Behind China's growth miracle lies a mountain of debt that has accumulated to dangerous levels. To fuel its investment-led growth model, China has borrowed extensively across all segments of the economy, including households, corporations, and local governments. Chinese households now owe between 60 to 64% of GDP, mainly in mortgages. With home prices falling, many families are seeing the value of their biggest asset decline while their debt obligations remain unchanged. Loan payments consume over half of many families' monthly income, leaving little room for consumer spending, which the government desperately wants to stimulate. Corporate debt levels are even more alarming, ranging from 123% to 172% of GDP. A significant portion is concentrated in local government financing vehicles, LGFVs, opaque entities that funded China's infrastructure boom. These vehicles are now sitting on approximately $13 trillion in debt, and about 80% of that is effectively in default. China's banking system, which is 3.5 times the size of its GDP, is increasingly vulnerable to this debt crisis. Non-performing loan ratios are likely much higher than officially reported, as banks are pressured to continue lending to struggling companies to prevent their collapse, a practice known as extend and pretend. This creates a debt trap from which there is no easy escape. China is too leveraged to grow fast, yet too fragile to allow the necessary deleveraging to occur. The government knows that suddenly cutting off credit could trigger widespread defaults and unemployment, but continuing to pile on debt only postpones and potentially worsens the inevitable reckoning. China's debt situation is particularly dangerous because it was used to fund investments with diminishing or negative returns. Empty apartments, underutilized infrastructure, and industrial capacity that exceeds domestic and global demand. Unlike productive debt that generates returns sufficient to service itself, much of China's debt has created assets that cannot generate adequate cash flow. Beyond the property collapse of debt burden, China faces a deeper crisis, a profound loss of confidence among consumers, investors, and businesses. Without confidence, no amount of government stimulus can restore healthy economic growth. The central bank's Income Confidence Index registered just 45.6% in the second quarter of 2024, down 4.4 percentage points from early 2022. China's household savings rate surged to 55% in 2024, up 11.2 percentage points from 2023, and the highest level since 1952. Rather than spending their income to drive economic growth, Chinese households are hoarding cash for fear of what lies ahead. Foreign investors are also losing faith in China's economic model. Foreign direct investment dropped 27.1% in 2024, following an 8% decline in 2023. The share of private enterprises among China's largest listed companies declined sharply over 3 years, from 55% in mid-2021 to just 33% in mid-2024, reflecting the government's shift away from market liberalization toward greater state control. Youth unemployment remains stubbornly high at over 17%, a particularly troubling statistic in a country where young, educated workers should be driving innovation and productivity. Many young, educated Chinese have joined the ranks of the professional children, adults who live with and depend on their parents, unable to find jobs or build independent lives. This widespread loss of confidence has created a perfect storm for deflation. When consumers expect prices to fall further, they delay purchases. When businesses expect weaker demand, they cut prices to attract consumers. When investors expect lower returns, they withdraw capital or demand higher risk premiums. These behaviors become self-reinforcing, creating a deflationary spiral that is exceedingly difficult to break. Xi Jinping faces a profound policy dilemma. The tools that worked during previous slowdowns, massive infrastructure spending, easy credit, and property market stimulus, are no longer effective. Despite being the most powerful Chinese leader since Mao, Xi has fewer available economic options than his predecessors. He has made it clear that he intends to stay the course, doubling down on state economic control, rather than embracing market reforms that might revitalize growth. The private sector, once the most dynamic part of China's economy, has lost out as state-owned enterprises gain favor. Xi's governance style has further complicated economic management. He has centralized decision-making, cracked down on dissent, and intensified regulatory pressure across sectors. Companies like Alibaba and Tencent, previously given latitude to innovate, are now grappling with new restrictions that have sent ripples through China's business community. The government's stimulus measures have consistently fallen short of expectations. Rate cuts and liquidity injections have had limited impact because households and firms are already over-leveraged. Fiscal stimulus has focused on supply-side spending and infrastructure rather than boosting household income and consumption. Local governments with traditionally implemented central government policies are effectively immobilized. Saddled with debt and falling land revenues, they are scaling back services and lack the capacity to support recovery. Their paralysis has become a major drag on national policy execution. Xi appears reluctant to implement the bold reforms needed to transition from investment-led to consumption-driven growth. This would require redistributing income from state-owned enterprises to households, strengthening social safety nets, and allowing market forces greater influence. All steps that would potentially reduce the party's control over the economy. Instead, he seems to be betting on manufacturing exports to offset the property downturn. However, this strategy faces significant headwinds in the form of trade tensions, tariffs, and a global economy increasingly wary of Chinese overcapacity. Just as China struggles with deflation, overcapacity, and crumbling confidence, it faces renewed trade tensions with its largest export market. The United States has implemented significant tariffs on Chinese imports with the potential for further increases. The timing could not be worse for Beijing. Unlike in 2018 when the first round of tariffs sparked fears of inflation, today's tariffs weaponize deflation. In a deflationary environment, tariffs don't raise prices, they crush the weakest supplier. With factories running far above demand and prices already falling, Chinese exporters have no leverage. This puts China in an impossible position. To combat deflation and stimulate domestic growth, exports need to be boosted. Yet boosting exports through currency devaluation or subsidies would likely trigger even higher tariffs from trading partners. The trade surplus, which reached a record $992 billion in 2024, may seem like a strength, but it actually reflects China's failure to develop robust domestic consumption. It also makes the country vulnerable to changes in trade policies by major partners like the United States and the European Union. China's current situation draws striking parallels to Japan's experience in the early 1990s. After decades of spectacular growth, Japan faced a collapse in its property and stock markets, leading to what became known as the Lost Decades, a prolonged period of economic stagnation from which the country has never fully recovered. Like China today, Japan in the late 1980s had an overheated property market, excessive corporate debt, and an economy overly dependent on exports and investment rather than domestic consumption. When the bubble burst, Japan's GDP growth plummeted from high single digits to near zero, where it has largely remained for over 30 years. The comparison becomes even more concerning when considering China's demographic challenges. Japan's aging population contributed to its inability to revive growth. China, due to its one-child policy, is aging even faster than Japan did, before reaching comparable levels of per capita income. The declining working-age population and rising dependency ratio will further strain China's growth potential and pension systems. The pension system is at a risk of running dry by 2035, creating additional economic and social pressures. However, China's situation may ultimately prove even more challenging than Japan's. Japan was a democracy, with high per capita income and strong institutions when its crisis began. China is an authoritarian state with still developing institutions and a per capita income of just 1/4 of Japan's at the onset of its crisis. Moreover, Japan's crisis unfolded in a favorable global environment with strong trading partners and relatively open markets. China faces a more hostile international economic environment, with major economies actively working to reduce their dependence on Chinese supply chains. As China's economic challenges continue to unfold, what steps should investors, businesses, and policymakers take to prepare for the potential fallout? Share your thoughts in the comments below, and don't forget to subscribe for more analysis of the global economic forces shaping our financial future.